What if I told you that one of the most heavily watched quantum computing companies in America right now actually makes like 30 times more money acting as a high-yield savings account than it does selling quantum technology?
I mean, honestly, it sounds like a punchline to a joke about, modern tech
Uh-huh.
valuations, but when you actually dig into the filings, it's the absolute reality of their balance sheet.
Right. Well, welcome to the deep dive. We are thrilled to have you with us today. Our mission is to unpack the recent Q4 2025 earnings of Quantum Computing Inc., which is pretty universally tracked under the ticker QUBT.
Yeah, and if you've been following the quantum sector at all, you know the hype cycle is just deafening right now.
Completely deafening. So our goal today for you listening is to really cut through all that noise and figure out if QUBT is actually a solid investment today.
Exactly. And to do that, we are synthesizing a pretty massive stack of source material. We've got QBBT's December 2025 investor presentation, the raw transcripts from their Q4 and full year 2025 earnings call, some deep dive financial modeling from Ticker Nerd and the Motley Fool.
And we also have the latest architectural tracking from Quantum Zeitgeist, right?
Right, yeah. We need all of that to get a complete picture.
And the whole reason we're doing this deep dive for you today is because the actual paradigm of quantum computing is fracturing.
Hmm.
Like, when you picture a quantum computer, you probably visualize those massive golden chandelier-looking structures suspended inside sterile labs.
Yeah, the ones freezing at near absolute zero.
Exactly. That's the industry standard, right?
Has been for years, yeah.
Yeah.
But it requires guzzling immense amounts of electricity just to keep the system stable enough to perform, basic calculations. It's essentially an incredibly expensive physics experiment.
Right. An experiment that really struggles to scale into a commercial data center-ready product.
Precisely.
But, and this is the hook, QUBT is attacking this from a completely different angle. They aren't building chandeliers. They are building actual physical, scalable chips that operate at room temperature.
Which is massive.
It's a game changer, and they are doing it with a war chest of over $1.5 billion in cash, sitting in an environment where Wall Street analysts are projecting some seriously aggressive upside.
But we can't really evaluate those analyst targets or even the Q4 financial numbers until we actually understand the underlying mechanical foundation. Like, what is QUBT actually manufacturing that lets them bypass those massive refrigeration units their competitors rely on?
Yeah, let's break down the mechanics because the pivot they've made here is just fascinating. So traditional quantum computers generally rely on isolating electrons to create qubits. And the best way I can conceptualize that for you is imagine electrons as hyperactive children packed into a gymnasium.
Okay, I like this analogy.
Right. So if you want to accurately read what those kids are doing, their state, in quantum terms, you basically have to freeze the entire room to absolute zero just to force them to sit perfectly still. Any ambient heat, any vibration, and the data falls apart. It's called decoherence.
Yeah, it's a very visual way to put it. The thermal noise just completely overpowers the quantum signal.
But QUBT doesn't use electrons at all. They use photons. They're literally computing with light.
Right.
And continuing that analogy, photons are like laser beams. They do not care if the gymnasium is freezing cold or 100 degrees. They travel in a straight, coherent line, regardless of the room temperature.
So by shifting the medium from electrons to light, QUBT suddenly has a quantum processor that can just sit on a regular server rack.
Exactly. But how are they actually doing that?
Well, the mechanism enabling that leap is their specific technological moat. QUBT is currently the only pure-play nonlinear quantum optics and integrated photonics public company.
Okay, pure play nonlinear quantum optics. That's a mouthful.
It is, yeah.
Hmm.
But the material that makes this physical chip possible is called TFLN, which stands for thin film lithium niobate.
Let's hover on that for a second because the sources really emphasize that TFLN is highly nonlinear. For those of us who, don't have PhDs in optical physics, why is nonlinearity the secret sauce here?
It's actually pretty intuitive once you break it down. Think of a standard pane of glass. It's linear. When a beam of light passes through it, the light just continues on its way, entirely unchanged.
Okay, the photons don't interact with each other.
Exactly. But for quantum computing, you absolutely need photons to interact so you can entangle them and actually perform logic operations. TFLN is a nonlinear material. This means when you pump light into it, the material actively forces the photons to mix, interact, and even change frequencies.
Oh, wow.
Yeah, it basically allows you to generate entangled photon pairs directly on the chip with extremely low noise and super high efficiency.
Okay, so they have this exotic, highly efficient material, but having a great material in a lab doesn't equal a commercially viable product. The detail in the investor presentation that really caught my eye was that TFLN is CMOS compatible.
Yes, and that is perhaps the most critical business advantage they possess.
Because CMOS compatibility means
It means that TFLN chips can be manufactured using the exact same photolithography processes that the global semiconductor industry has spent the last 50 years perfecting for traditional silicon chips.
right, meaning they don't have to invent a completely new type of factory just to build their products.
Precisely. They can just leverage legacy semiconductor infrastructure. They are adapting a revolutionary material to existing highly optimized manufacturing paradigms.
And they're moving aggressively to control that process, too. I mean, in early 2025, they opened Fab 1 in Tempe, Arizona. And this isn't just some design studio. They are physically processing 150 millimeter TFLN wafers there.
Which establishes a massive physical barrier to entry. According to the industry tracking, they are currently the only U.S. company capable of processing TFLN at that specific wafer size.
And when you consider that the global photonic integrated circuit market is projected to hit, what, $65.69 billion by 2032?
Yeah, nearly $66 billion.
Owning the only domestic facility capable of churning out these specific chips puts them in an incredibly powerful position.
It's a textbook Goldilocks position for capturing market share. But the choice to build Fab 1 in Arizona introduces a much larger variable into their valuation.
The geopolitics.
Right. This physical infrastructure ties directly into the volatile geopolitical landscape and the harsh realities of the global supply chain.
And just to be incredibly clear here for you listening, our sources dive heavily into the political push to decouple U.S. technology from Asian supply chains. We are not taking a side on global trade policy or endorsing any political viewpoints here.
Right. We're strictly reporting on how the market, the sources, and these financial analysts are pricing in QUBT's strategic decisions.
Exactly. So from a purely operational standpoint, why is the domestic fab so important?
Well, the global supply chain for advanced semiconductors is just severely constrained right now. Relying on overseas mega foundries introduces significant delay and massive IP vulnerability.
It's a friction point that even massive entities like IBM and Intel are currently struggling to navigate.
Absolutely. And if you are a company like QUBT iterating on brand new quantum chip designs, you literally cannot afford to wait 6 months for a prototype batch to arrive from overseas just to find out you need to tweak the architecture.
Right. Speed of iteration is life or death for an early-stage tech company. By owning their domestic TFLN fab, they basically control their own destiny.
They safeguard their intellectual property, they can prototype and test in a matter of weeks, and crucially, they fulfill the strict compliance requirements of early adopters who demand absolute security.
And we're really seeing the proof of that in their early customer base. The Motley Fool analysis points out that their early revenue is overwhelmingly domestic. They recently secured a purchase order from a top 5 U.S. bank specifically for their quantum security solutions.
And let's be real, banks of that tier do not integrate unproven hardware into their security infrastructure.
No, never.
That purchase order acts as a massive validation signal to the rest of the enterprise market.
Not to mention their government ties. I mean, they have an advancing partnership with NASA for scientific and environmental research modeling, and their technology is actively utilized by the U.S. Army Research Laboratory.
Yeah, when you have the federal government and top-tier financial institutions as your earliest adopters, spending the capital to build a domestic, highly secure foundry in Arizona looks a lot less like an expensive gamble and more like a mandatory strategic asset.
It really is the physical anchor of their economic moat. But, a moat only matters if it eventually protects a castle filled with revenue.
Sure.
We need to transition from the theoretical potential of TFLN to the brutal reality of the Q4 2025 earnings report. Because let's look at the actual math here. If you pull up their income statement right now, the numbers are genuinely going to give you whiplash.
They are pretty stark.
For the fourth quarter of 2025, QUBT reported revenue of $198,000.
So it is worth noting that is a 219% increase year over year.
I hear you, but $198,000 is still like the revenue of a moderately successful coffee shop.
Fair point.
And for the full year of 2025, their total revenue was just $682,000. If you are an investor looking at those numbers, you have to ask a hard question.
Which is?
If this room temperature technology is so groundbreaking and they have NASA and top-tier banks validating it, why are they bringing in less than $1 million a year? Especially considering their operating expenses for Q4 alone exploded to $22.1 million.
Right. It's a huge disparity.
Yeah.
But that massive gap between revenue and operating expense is really the defining characteristic of a company transitioning out of pure research and development into commercial scale-up.
So the 22 million isn't just them setting money on fire.
Not at all. That 22.1 million isn't wasteful spending. It is heavy, necessary investment in elite engineering talent, research, and expanding their manufacturing footprint.
I mean, I get that you cannot build a fundamentally new architecture for computing on a shoestring budget, but burning $22 million a quarter with less than $1 million in annual revenue usually means a company is staring down bankruptcy.
Usually, yes. Which brings us to the most vital takeaway from the earnings call, and really the counterintuitive fact we opened the show with.
The savings account thing.
Exactly. Their balance sheet is an absolute fortress right now. In 2025, QUBT successfully raised $1.55 billion.
Billion with a B.
Billion with a B. And the bulk of that came from a staggering $750 million private placement from institutional investors entirely in the fourth quarter.
So they closed out 2025 sitting on $1.52 billion in cash and short-term investment.
Meaning they have decades of runway at their current burn rate. And because they are sitting on that mountain of cash in a high interest rate environment, QUBT reported $20.7 million in interest income for 2025.
This is the part that just blows my mind. They generated $682,000 actually manufacturing and selling their revolutionary quantum photonics, but they generated almost $21 million just by letting their cash sit in the bank.
It's wild.
They're literally making 30 times more money acting as a vault for their own capital.
It is a remarkable financial anomaly for sure. In fact, if you look at their Q4 net loss, it improved drastically to just $1.6 million.
But not from selling chips.
Nope. That improvement was almost entirely driven by $13.6 million of quarterly interest income and a $7 million non-cash derivative liability gain.
It's a great safety net, obviously. But investors aren't pouring $1.5 billion into a tech company to earn standard interest yields. The mandate is to deploy that capital and fix the revenue gap.
So how are they actually turning that cash pile into commercial growth?
By executing a highly aggressive acquisition strategy, they realize that organic sales cycles in enterprise hardware take years. You don't just sell a quantum chip overnight.
Right.
So to accelerate that, they are simply buying established companies to instantly acquire revenue streams and solve manufacturing bottlenecks.
And the centerpiece of this strategy is Luminar Semiconductor, or LSI.
Right.
They closed the LSI deal in February 2026 for $110 million in cash. But what does a quantum computing company want with a semiconductor subsidiary known for lasers and LiDAR? It actually solves a massive mechanical headache for them. In integrated photonics, one of the absolute hardest manufacturing challenges is packaging.
Packaging, like putting it in a box.
No, specifically the physical act of perfectly aligning microscopic fiber optic cables to the waveguides on the chip itself. It is historically a very low-yield, highly complex bottleneck.
Oh, gotcha.
LSI brings world-class established capabilities in advanced packaging, detectors, and lasers. QUBT essentially bought a pre-built solution to their hardest manufacturing problem.
That makes a lot of sense. And beyond the engineering fix, LSI brings immediate financial relief. During the earnings call, QUBT's CFO, Chris Roberts, was careful to state they don't provide forward guidance. But he pointed to analyst projections suggesting LSI could add $20 to $25 million in annual revenue right out of the gate.
Which is huge. They overnight transformed the run rate from under $1 million to potentially north of $25 million.
Right.
And they also instantly doubled their workforce, absorbing LSI's specialized talent pool.
But they didn't stop there. The Quantum Zeitgeist tracking noted a smaller but highly targeted acquisition, NuCrypt, for $5 million in a cash and stock mix.
Yeah, NuCrypt is a brilliant strategic IP play. It drastically expands QUBT's capabilities in quantum communications and security.
And the crucial detail here is that NuCrypt brings in technology and patents that are already entrenched in federal infrastructure, right? They're heavily utilized by institutions like Fermilab and Argonne National Laboratory.
Exactly. They are systematically consolidating the intellectual property required to dominate the emerging quantum networking sector.
Okay, so the picture we have for you now is a company with a wildly unique room temperature architecture, a $1.5 billion war chest, and a strategy of buying up complementary IP and instant revenue.
That's the setup.
But they are operating in a sector full of absolute giants. How does this strategy actually map against the wider competitive landscape? And how is Wall Street modeling the risk?
Well, the broader quantum sector is essentially an arms race divided by architecture. On one side, you have companies like Rigetti who are doubling down on traditional superconducting circuits. They recently reported achieving up to 99.9% 2-qubit gate fidelity.
Which is a massive milestone for error correction in supercooled environments.
Right. And then you have IonQ, who uses trapped ion technology. They're pursuing a massive $1.8 billion vertically integrated manufacturing deal with SkyWater.
So if the competitors are throwing around billions to perfect these deeply complex cryogenic systems, how does QUBT carve out a market with room temperature chips?
By refusing to fight on the same battlefield. Rigetti and IonQ are racing to build massive general-purpose quantum computers. QUBT is focusing heavily on application-specific hardware.
Meaning they aren't trying to do everything for everyone.
Exactly. At the Supercomputing 2025 conference, QUBT unveiled their neuron wave system. It is a photonic-based reservoir computing system specifically optimized to tackle artificial intelligence workloads.
Okay, but why does AI need a completely different type of quantum system?
Because modern AI relies on continuous, massive matrix multiplication. Traditional silicon chips use an immense amount of energy to force electrons through logic gates to do this math. QUBT's neuron wave system uses the natural physical properties of interacting light to perform that math passively at room temperature.
So it offers a path to scale AI computation without the exponential energy penalty.
Exactly. It's incredibly efficient.
Which naturally leads us to how the market is valuing that potential. I pulled the aggregate analyst data from Ticker Nerd, and the consensus is genuinely surprising. Out of 5 Wall Street analysts actively tracking the stock, the overall consensus is a strong buy, carrying an 8.4 out of 10 rating.
What is the specific distribution of those ratings? Like how many buys versus sells?
That's the part that really stands out. We have 3 buys, 2 holds, and exactly 0 sells.
0 sells.
0. In a highly volatile pre-revenue tech sector, not a single major analyst is telling investors to abandon ship. With the stock currently trading around $7.60, the median analyst price target sits at $16. That implies a 110.5% upside.
Does the data show significant divergence at the extremes?
Absolutely. The most bullish model comes from Edward Rue at Ascendiant Capital, who set a price target of $25, which is a nearly 229% upside from current levels.
Wow.
Yeah. On the more conservative end, Troy Jensen over at Cantor Fitzgerald maintains a neutral rating, but even his low target of $10 implies a 31% gain. We also saw John McPeak at Rosenblatt and Max Michaelis at Lake Street initiate coverage recently, and they both slap buy ratings in the $22 to $24 range.
Look, while that uniform optimism is compelling, if you are analyzing this as an investor, you must look at the valuation metrics alongside those price targets. The fundamental ratios are severe.
Severe is putting it mildly, honestly, because they have virtually no organic revenue yet. They're trading at a PE ratio of -69, and their operating margin is -11,220.2%.
Let that margin sink in for a second. -11,000%.
Yeah.
It illustrates perfectly that you cannot evaluate QUBT as a traditional value stock. It functions entirely as a high-growth, high-risk venture capital play that just happens to be available on the public market.
Right.
The valuation is not based on their current $682,000 in revenue.
No.
The market is pricing in their ability to successfully digest the Luminar semiconductor acquisition, and more importantly, their ability to execute on Fab 2.
Right, because Fab 1 in Arizona is essentially limited to prototyping and low-volume production.
Exactly.
During the earnings call, CFO Chris Roberts confirmed that planning for Fab 2, which is their true high-volume manufacturing facility, is already underway. Though he managed expectations by noting they don't foresee major capital expenditures for Fab 2 in 2026.
Meaning the real execution test is 2 to 3 years out.
Right.
Which means the ultimate risk here is execution.
Yeah.
Having $1.5 billion provides an incredibly forgiving runway, but capital alone does not guarantee manufacturing yields.
No, it doesn't.
They have to prove they can transition from handcrafting bespoke chips for NASA to mass-producing millions of defect-free units that the global AI and cybersecurity markets can actually rely on.
Well, let's pull all these threads together for you because we've covered a tremendous amount of ground today. To synthesize the deep dive, QUBT is a highly capitalized, pure-play photonics company. By leveraging the nonlinear properties of thin-film lithium niobate, they are building room-temperature quantum hardware that snaps directly into existing CMOS manufacturing pipelines.
And they have secured a crucial domestic manufacturing moat in Arizona, insulating them from overseas supply chain shocks while attracting highly secure government and financial clientele.
Right. And while their organic revenue is currently negligible, they have amassed a $1.5 billion cash reserve, generating massive interest income while they aggressively acquire companies like Luminar Semiconductor and Newcrypt to bolt on instant revenue and solve complex packaging bottlenecks.
And Wall Street is modeling massive upside, but as we said, it requires flawless execution on scaling their future foundries.
Which leads us to a final underlying implication of this technology that you might want to mull over.
Yeah, this is something that doesn't get talked about enough, but might be the most disruptive factor of all.
As artificial intelligence continues to demand exponentially more power, the ultimate bottleneck might not be the software. It might be the physical hardware and the energy grid itself.
Exactly. If we keep using traditional silicon chips to power AI, we're literally going to melt the world's power grids.
Yeah.
We just don't have the energy capacity to scale it.
Right. But if quantum photonics proves to be the only viable way to process massive AI workloads passively at room temperature without that insane energy penalty.
Then the true winner of the global AI race isn't necessarily the company with the best language model.
No. Is the true winner of the AI race the company that controls the domestic supply of thin-film lithium niobate chips?
It's a massive paradigm shift. It's definitely something to think about as you watch this company scale over the next few years.
It really is. Thank you so much for joining us on this deep dive. As always, keep questioning the numbers behind the headlines, look past the hype, and we will catch you next time.